Welcome back, traders. It's John at Rain King LLC. Time for a general market update. It is May 12th, 2023. Just a reminder, this is a presentation by Rain King LLC, and I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. So the agenda this week, I'm going to focus more on the big picture this week. There was not a whole lot that changed during the week. So we'll look at the big picture. We'll look at something called generals or soldiers, then the Fed Watch and rates, then something on the sectors, and then we'll wrap up with a quick summary. So let's get into the big picture. This is a weekly chart of the NASDAQ composite. And I just wanted to show you the big picture in terms of these lines of resistance which exist. If you ran a Fibonacci set from the COVID lows to the peak in November of 2021, I've highlighted the 38.2 retracement line, which is in black. You'll see that that line has actually become some resistance on a couple of the rallies that we've had in the NASDAQ. Coincidentally, if you look at the decline from the top to the ultimate low in October, a 50% line at that decline is about NASDAQ 13,150. And you'll notice that that happens to coincide with the top of the range that we've been looking at on the daily chart. So let's take a look at that chart. So here we are. The beige color here is that line of resistance that we talked about, which happens to coincide with the 38.2 fib level. You see it's been a plague. Now, just in the last 2 days, the NASDAQ composite has broken above that, but today it's being kind of slammed back down. We haven't been this high in the NASDAQ composite since way back in September of 2022. So it seems to be the only index, though, that's making new highs. If it were to continue to rally, probably the next resistance zone is somewhere up in this area in yellow, which is right around the August of 22 highs. So generals or soldiers. So we're going to use this theme to look at the breadth. This is the NASDAQ advanced decline line as of yesterday. Now, you can really view the index representing the generals. If you're going into a battle, you have generals, then you have your troops or your soldiers. And you can see the generals here are still marching higher, led by that handful of really mega cap names leading the index. But the advanced decline line really is representing the soldiers, because that's all the other stocks that make up the composite. And you'll notice that the line is really, really further deteriorating. It's been very, very poor. So it's not a good picture. The soldiers just aren't participating along with the generals. Here's the advanced decline line of the New York Stock Exchange. The upper panel shows the S&P 500, which is trying to break through some resistance. But again, look at the soldiers. The soldiers are just deteriorating. We've actually turned much lower this week. So it's just terrible breadth in the market right now. Can't see a real big, strong rally occurring in this situation. This is the New York Stock Exchange, just percentage of stocks above the 200-day moving average, which is a really good configuration to show how many stocks are in at least a medium-term, intermediate-term uptrend. Again, the line is showing you a deterioration continues. We're down to 47% is above the 200-day moving average. So it's just getting worse as we go, even though the index is still kind of fluttering around this resistance level in the 41 to 4,200 range. We just don't have the soldiers participating even in the S&P. Moving to the NASDAQ, this is the weekly chart of net new highs minus new lows. And it's just obvious. There has not been any net new highs in this particular indicator in months. There's just nothing, no net new highs for weeks and weeks on end. It's just not the type of picture. You can see the rally that we had in January. At least we had net new highs that was helping us have a little bit of confidence about the rally. So far, it's nothing, nada. So let's go to the CME Fed Watch. So if you go to the CME Fed Watch on the web, they show essentially what are the odds that the market is anticipating for rate increases into the future. So this happens to be the projection for the June meeting coming up in a few weeks. Now, the current rates are at this 500 to 525 level basis points. So what this chart is showing is there's an 87% chance or odds that the Fed does not increase. They're showing 87% says we're going to remain at the 500 to 525 basis points. And it's showing us that a raise of a quarter point, there's only a 13% odds that the Fed is going to raise a quarter point in June. Now, I've included the December forecast, looking out a good 6 months. And my question is, how do we get from here, 500 to 525, to what we're seeing on the December forecast? Now, if you look at the December forecast, these numbers are forecasting 400 to 425, 425 to 450. So depending on how you gather these, it's showing that there's a 77% odds that the Fed will have cut rates by 100 basis points by December. So how do we get from here to here? And you'll also notice that in this particular December forecast, there is a 0% chance people think that the Fed will still be at the rates that we have today. So this is really a little bit odd. You have to ask yourself, how do we get there from here? And you really have to ask yourself, does the market see something really bad coming? You know, we know that the Fed does not want to cut rates too quickly because they run the risk that we're just going to reignite inflation. So that would undermine almost an entire year's worth of work. If they were to cut rates in August, September, October, November, and inflation were to kick back in, they would have ruined the past year of the work they've done to try and bring inflation down. Now, you can only imagine things are going to be pretty bad for the Fed to do that. And you have to wonder, are there more regional bank failures that are coming that we just don't know about? Or is the economy going to fall off a cliff and have a very, very hard recession? So hard that the Fed can't maintain their plan to fight inflation, and they actually react to a hard recession. So it's a strange picture. The market does look ahead. So the market is not in sync with what the Fed is saying at the moment. We'll have to see how it plays out, but this is a cloud of uncertainty. We'll see how it goes. So a quick look at sectors. And I'm looking at the NASDAQ composite, which is this line in red. And then I called up three essentially growth tech-oriented ETFs, XLK, which is tech, XLY, which is consumer discretionary, and XLC, which is the communications ETF in the S&P. You'll notice that when the market bottomed in October, that's right about when the XLK technology index bottomed, and it's been grinding its way higher, primarily led by the FANG names. Then you'll see the XLC in yellow was the next ETF to bottom, and it's also been grinding its way higher. I believe Google's in there and Meta's in there. And then the consumer discretionary in the teal color didn't bottom out until January. And actually being discretionary spending, it's gone kind of sideways. It has not been really, it's been a very, very minor uptrend, but it's really sideways. So these are an uptrend. So there is some buying going on in these. Now you might say, John, that's only the 4 FANG stocks or 5 FANG stocks, which is definitely a big, big part of that. But there is select growth being purchased in the marketplace. We've been seeing some earning gaps that are starting to hold and work a little bit, but by no means is it the dominant theme. Now on the right side is the Dow Jones Industrials in red. And you can see since all of 2023, the Dow has basically been going sideways to down. It could not get to new highs here in April, and it's really starting to curl lower. Now the Dow, don't forget, is consisting of cyclical stocks, industrial stocks, energy stocks, and I just pulled a few of them. You can see that 3M's been in a downtrend for the whole year. Dow Chemical down for the year. Now Caterpillar was starting to move in early January, but now it's completely come down to new lows. Caterpillar, another big cyclical machinery stock. And Chevron, you can see that with oil prices coming down, The big oil names, commodity names have also come down. This is really typical of the late cycle, economic cycle that the industrials and the cyclicals have. They're turning down. You have to really be tuned in to say this is probably forecasting a lot more economic weakness coming in the second half of the year. Further, if you look at copper futures, copper is an important metal. It's in so many different products across the globe, so it's a really good indicator of industrial and industrial production on a worldwide level. You can see copper had not been able to get up to its old highs. It's kind of formed this little double top, and it's curling down. You have to wonder if this is also signaling a slowdown in the global economy. USO oil on the right side of the chart, and you'll notice that we're almost plumbing new lows. We're between $60 and $65 a barrel. It's amazing. A year ago, we were up in the 90s. So again, these are just really telling us that the economy on a global level, it looks like it's softening. So as a summary, there wasn't a huge amount of changes from last week. As we noted, there's still deterioration under the hood. We have poor breadth. We have new highs, new lows, which are still very, very weak. And defensive sectors are certainly still getting most of the money flow, that being the consumer staples, healthcare, utilities, all defensive. Now, the PPI last week came in as expected, really didn't move the markets that much. The big question is the Fed going to officially pause at the June meeting? We'll have to see how that plays out. As I mentioned in the last slide about rates, does the market know something bad coming down the tracks that could shake the Fed into cuts? I would imagine they do not want to cut at all in 2023 if they can prevent that. But it's a lot easier to do rate hikes when there's a strong economy and there's strong job growth in the country. Now that the job growth is starting to see more layoffs, we're starting to see the numbers come down. Will the Fed have the resolve to stay to their plan to knock inflation back as their priority? We'll have to see how that goes. The Fed, as we all know, has a very loose record of their ability to predict things. Now, growth, earning gap ups, earning reactions, there are some holding, which is a positive. They're not dominating, but you can see there are some, Chipotle and Uber and Celsius had a nice move this week, and a couple of others. So that's positive because there is some buying going on, because when the next economic cycle starts and we do get rate cuts, that's usually a really strong environment for growth. So we'll see this as possibly some transition, some positioning by institutions, which may occur over the next several months. The NASDAQ's at its highest level since September of 2022. Unfortunately, it's the only index that's really confirming that. We'd really like to see the S&P move above that range that it was in between 4,100 and 4,200 to really confirm there's some strength and broadening of the rally. We don't see it yet. So all we can do is really interpret what we see. The market still looks a little vulnerable here. I'd be very cautious. Make protecting your account your priority. It is conceivable that if you're a little bit more on the aggressive side, you could try some pilot positions on these earning gaps. I would definitely wait for the report. I would not be buying stocks before an earnings report. That's very dangerous and not recommended. But make sure you use stops. Gaps that are working may be rewarding for a 10 to 15 day period. We'll see how it goes. So I can see possibly someone asked me in the last video about exposure levels. I can see people that may have exposure levels of 0 to 20% at this time. I can't see much more than that given the environment. 100% cash is also a good place to be here. There's not much you're missing by taking positions in this environment. So when you're going into battle, you need your soldiers in addition to your generals. The market environment's still very difficult. And right now, we do have some generals that are working, but not enough soldiers really to make an attack at moving this market higher, but that can change. So be patient and keep observing the market. Now, in the past 2 weeks, I've tried something a little different. I'm introducing something called the General Market Update Extra. And I'll call it the GMU Extra. That's where I'm going to be issuing some short 5-10 minute educational videos about trading lessons, trading hacks, some of my experiences, and I'll try to make those sprinkle them in. So you'll see things like I've done 2 already. I did a GMU Extra on institutional accumulation distribution. And earlier this week, I did a trading hack on flattish bases. So if you like those, let me know and I can continue to do them. I'm always looking for ideas for topics that may be of interest to you. So please just shoot me an email. Let me know what's on your mind, what you'd like to see or hear, or you're struggling with, or what you want to see more of. And I'm going to try and make a series out of these GMU Extra videos. So that's the market update for May 12th. I hope everybody has a great weekend. There's where you can find me on Twitter, YouTube, and my email. We'll see you all at the next General Market Update.